Monitoring and managing a portfolio of direct investments. One of the challenges with investing in early-stage companies, or private companies in general, is that there is no easy, immediate way to determine the value of the company. With public companies, you can see the stock price at any given time. You can easily see how much your investment has grown, or not, over any time frame you want. You can even manage your entire portfolio with any number of free apps or websites. But this is not the case with private companies. One of the advantages of direct investing in private companies is that you can actually influence a company's performance. If you invested $1 million in a large public company, you would probably not even get to meet the CEO of the company, let alone expect that he or she would listen to your advice. However, if you invest $1 million in a small private company, you would probably get the CEO's personal email address and cell phone number, and he or she may even call you to run something by you or to ask for your help. In this video, we will discuss some best practices for monitoring and managing a portfolio of direct investments. This really breaks down into two issues, which we will look at separately. Monitoring, knowing how well each investment is performing individually and how well your entire portfolio is performing as a group, and managing, influencing and optimizing the performance of each individual investment and the portfolio as a whole to meet your family office's goals. Monitoring. Again, without the convenience of looking online at a stock price updated every minute, how do you monitor the changing value of your investments, and hence potential return of your investments? In short, you can't day trade angel investments. Instead, you need to have a multi-year time horizon and help drive the company towards a clear exit so you can realize a positive return on your investment. Instead of watching how others value the company, what a stock price really shows, you can track a company's performance towards specific goals. What goals? It depends. You have to understand what drives value in your specific investments. Obvious examples include revenue and profit. The more profitable the company, the more valuable it should be. But it may not be that clear-cut. The value of an early-stage company can increase from a variety of efforts. For example, product development, getting a prototype built, building updated versions, filing for patents, being awarded those patents, etc. Business development, securing the first few customers, securing marquee customers, signing key partnerships, or any number of other business development successes. External factors. New regulations or laws may create or solidify market opportunities. A key competitor could abandon the market. Another company or technology may pave the way for your company with a complementary offering. Or a hugely popular celebrity may be photographed using your company's product or service. Ultimately, the value of your investment does depend on how others see it. If there is another expected financing round, those future investors determine the value. If you understand what they value, you can monitor the company's progress towards those goals. If you are trying to direct the company towards an acquisition, understand what drives value for potential buyers. Customers, revenue, intellectual property, strategic partnerships. You can thus monitor the company's progress towards these goals. The key is thus to set expectations or milestones that make sense and hold the company to those steps, which brings us up on how to manage the portfolio. Managing. Good investment management practices are complex and time-consuming, requiring discipline, patience, and consistency of application. This is from an article originally published in 1995 by Arthur Zeichel, president of Merrill Lynch Asset Management. This is true for managing direct investments as well. With this in mind, how do you influence and optimize the performance of each individual investment and the portfolio as a whole to meet your family office's goals? If you meet with your portfolio companies consistently, at least once a month, you can add value in a number of ways. For many, the main goal may be simply to keep the entrepreneur focused and disciplined. For young companies searching for success in particular, it can be easy for the entrepreneur to chase revenues down a rabbit hole or pursue a potentially lucrative opportunity at the expense of the long-term goal. With your industry expertise or overall business experience, you can help the entrepreneur weigh various options to chart the best course for growth. Having said that, you should also expect things will change. In fact, the entire business may change based on market conditions or unexpected innovations during product development. Maintain a patient, long-term view of the company and your portfolio. Whatever the direction, you can provide regular mentoring and connections from your professional network. You can help find management talent, key employees, customers, or even potential acquirers to help increase the value of the companies in which you have invested. Unfortunately, that doesn't always work out. Sometimes companies fail. When this happens, you need to cut your losses. With public markets, some say, when in doubt, get out. You don't always have to get out of a direct investment, or even write off a loss on your taxes, but you can mentally write it off and not invest more time and money in a company not growing as it should. As painful as it may be, this will allow you to devote more time and money to those portfolio companies still on track, still growing, and still increasing in value. From a portfolio standpoint, the same common sense advice may dole out for various investment strategies holds true for direct investments. Diversify. This may seem to contradict one of the findings of a recent Kauffman Foundation Angel Capital Education Foundation research that suggested investors should focus only on industries in which they have a deep experience. That implies a strategy of specialization, not diversification. However, you can surely diversify within a given vertical by investing in different segments of the industry and investing with different terms and companies in different stages of development. You can also invest in companies taking different approaches in the market. For example, consider the photography market several years ago. You could have invested in one company that produced a new kind of film, another company that was working on a new developing process that could be rolled out in grocery stores and big box stores, or another creating a new lens to fit with the camera. If you had the foresight, you could even protect against a possible disruption from digital images replacing film. You also could have invested in a company creating new digital cameras, another working on storage or memory devices for digital photographs, or a company that would allow people to upload their cameras on the internet to print out, or another company that allows people to create an online photo album to share. This may be an extreme example, but you can see how diversification protects against market risk and helps you realize an attractive overall return on your portfolio, even if some individual investments fail. Conclusion: monitoring and managing direct investments may be harder and take more work than similar efforts for indirect investments, but you can have more impact and influence as well. The same Kauffman Foundation and Angel Capital Education Foundation research suggests you should meet with portfolio companies at least once a month. This frequent monitoring and management led to higher returns than meeting with the companies only once or twice a year. In other words, simply attending annual meetings was less productive than regular, active monitoring and managing. We hope that putting forth the practices described in this video will help you to see higher returns on the investments you make on behalf of your family office's clients.